So this video will give you set up with the tools that you're going to need to follow along with this series of videos. So first we're going to go to the cengage.com/finance/may/analysis/9e. If you haven't already, go to Student Data Files, right click, open that in a new tab, and it will start downloading. Then open up Excel and go to File, Options, Add-ins. Going to go to the Excel add-ins, and you'll browse for wherever you save that file and make sure that the functions for financial analysis is checked and added into your Excel. Also, within this, let me cancel and demonstrate one more thing. Within that too, there's another add-in we want to include. So we'll go back to options, add-ins, and go. And then browse. And for me, I put this in the downloads. There's also within that same folder the Excel Sim add-in. For a Mac, you'll do the Mac one. For the Windows, you'll do the Excel Sim and click OK. And then I will click OK. So once those are added, this is your scenario. We have frozen catfish fillet project inputs, and they are as follows. Cost of land is $250,000. Cost of buildings and equipment are $400,000. Macker's class is 20. Life of the project in years is 5. Terminal value of the land is going to be equal to $350,000 times 1 plus D6. We'll have nothing there at the moment, but we'll change that shortly. Terminal value of buildings and equipment is also going to be equal to $200,000 times 1 plus the D8. Put an equal in front of that to make that a formula. First year catfish sales in pounds is 200,000 times 1 plus D8. Make this a formula. The previous one, this needs to be D7. Okay. Price per pound is equal to 2.50 times 1 plus D9. Unit sales growth rate is 8% multiplied by 1 plus D10. Put an equal in front of that. Make that formula. Variable costs as percentage of sales is equal to 60% times 1 plus D11. So when these in these D cells starting at 5, this will be sensitivity percentage, since we're now going to be incorporating risk. We'll go ahead and make these percentages 2 decimal places. Okay. Fixed cost will be 80,000. Tax rate 25%. Weighted average cost of capital 10%. So now we need to calculate the annual cash flows for the frozen catfish fillet project. So we'll have year 0, year 1, and we'll drag that across to year 5. So we'll have an initial outlay that is equal to minus parentheses B2 plus B3. Sales, variable cost, fixed cost, depreciation expense, taxable cash flows, taxes. We'll add depreciation back to get our annual after-tax cash flow, our terminal cash flow, and then total our annual cash flows. So we can go ahead and do this formula. It'll be equal to the sum of all of these. Or actually, in that particular case, it will be equal to that one. And then the others will modify accordingly. So think for this will be equal to the annual after tax and then the terminal. Okay. So our sales, that's going to be equal to B8 times B9. So that's pulling in the first year catfish sales. Then the following year will be equal to C19 times 1 plus B10 anchored. And we'll drag that across. And all of this will be to 1 decimal place. Next, we'll have variable cost. It's going to be equal to B11 anchored multiplied by C19. And we'll send that across. The fixed costs are equal to the 80,000 anchored. See for this, make sure to decrease that decimal. The depreciation expense. So this is going to be using an if error and a formula from the FAME functions that we added. So the formula is equal if error parentheses FAME underscore Mackers B3 anchored comma B4 anchored comma C12 comma false parentheses comma 0. And what's going on here? Okay, so let me go back and make these 0 1, and this represents the year. Okay, now we'll drag that across 1 decimal place. So our taxable cash flows will be equal to C19 minus the sum from C20 to C22. I'll drag that across. Taxes will equal C23 multiplied by B13 anchored. Drag the cross. We will add back depreciation. So that's our depreciation expense we calculated above. So then our annual after-tax cash flow is equal to C23 minus C24 plus C25. And then last, we have our terminal cash flow. That will equal the following formula. B6 minus parentheses, B6 minus B2 in that parentheses times B13 plus B7 minus parentheses, B7 minus parentheses B3 minus sum of C22 to G22 parentheses, parentheses, parentheses times B13. So that should get you 545,464. And then we'll double check our cash flows here. $695,251 in year 5, negative 650,000 in year 0. 1 is 93,750, 109, 219, 121, 637, 135, 133. Last but not least, we will do our NPV, profitability index, IRR, MIRR, payback period, and discounted payback period. So the NPV function equal NPV. Our rate is the WACC, comma, highlight 1 through 5 plus the 28. So there's that formula. Next, for profitability index, that's going to be equal to NPV, parentheses. Rate again is the 10%, comma. So years 1 through 5 cash flows. Then divided by the minus of the outlay. So you get 1.22. IRR, we just highlight the data. The MIRR, we will highlight the data, comma, and then we'll just do the 10% both times. So get those to 2 decimal places. Payback period, we can use a FAME function. So FAME underscore payback. And for this function, you need the cash flows. And then the rate, we won't need it for this one. And then the FAME discounted payback. Will then include the discount rate. Okay, so let me format painter those. All right, so now we have the spreadsheet set up to incorporate risk here momentarily.